three major stocks at 52-week lows: Comcast, Kohls, and Roku. Let's look at all three of them and decide if they've gone down far enough to purchase them. So we're going to use our 8-pillar process as part of our software to analyze these companies. A great place to start to look for value are 52-week lows. Now, I want you to remember, though, don't get sucked in to believe that just because it's a 52-week low means it's cheap. Let me give you a quick analogy. If I have a home that's worth $500,000 and I suddenly decide, let me go put it on the market for $5 million, it sits there and does nothing. Okay, here's what I'll do. I'll chop it in half to $2.5 million. Hey, it's a screaming deal, right? No, it's still only worth $500,000 a year. What I want you to learn, and if you're new to this channel, I'm Paul, I'm a value investor. What I want you to learn from me is something that I took 15, 20 years to understand. But I used to be like you back in the day. I heard reduction in price, therefore a good deal. No, better deal? Sure. Good deal? Not necessarily. I want you to remember that every investment is the present value of all future cash flow. And the more you pay today, the less return you make. So just because the stock is lower, will you get a better return than buying it at the peak? Absolutely. But is it still a good enough return? That's the question. So let's take a look at Comcast. Now, for those of you who belong to our software and our community, please follow along. And if you don't belong to it, I don't know what you're doing, but check out everythingmoney.com. This will be a game changer for you in how you look at stocks. So Comcast had a high of $61 a share, went down to $36.58 in the last year, and now it's at $38 essentially. So it's a little bit off its 52-week low. Let's look at some high metric stuff for Comcast. So market cap's $172 billion. They do $120 billion in revenue. Yeah, this PE last year of 12 and a 5-year PE of 12, very consistent. Now guys, they pay a dividend. The dividend yield on this main page is 2.7%. That pays out $4.6 billion. Now, if you're new to this channel, one thing I'll always want you to remember, just because a company pays a dividend does not necessarily mean that it is a stable dividend. You want to compare it to the free cash flow. That's why I put it right below free cash flow. Last year, Comcast had $16.6 billion in free cash flow. In the last 5 years, they averaged $13.5 billion. This 4.6 is easily affordable under this 5-year free cash flow and last year's free cash flow. So excellent. Now, instead of going through every single step of these companies, let me go to the 8 pillars. So the 8 pillars right here. All right, a little bit of a mixture. A lot of debt here. So that's my first, I don't like a lot of debt. I want this under 5. It's taking their long-term liabilities, dividing it by their 5-year average free cash flow. That's a little high. 11's high. 5-year return on invested capital. Okay, not great. We want it over 9. And net income growth is down $9 billion. Now, here's the interesting thing about net income growth. You had revenue growth of $33 billion, free cash flow growth of 6.5, but net income loss of $9 billion. So let me go to their income statement and see why that may be. So remember, guys, the 8 pillars are going to tell you a story. First thing I see when I see that is, why is their net income so much lower? Well, here it is, guys. You ready? Here was the start of the decade. 6.5, 7.3, 8.6, 8.2, $9 billion, 23. Back down to 12. So guys, I immediately think to myself, that X should be a check. I'm not worried about that. They obviously probably sold something in this year that made a lot of money. So let's scroll up a little bit. And I don't quite see it here, but somewhere buried in their statements will be something having to do with some sort of gain, and we probably don't have it right here. But if you look, the revenue was very consistent. So guys, I don't even worry about that X. So right now we only have 2 X's I worry about. The debt levels and the low ROIC. So with higher debt and a lower return on invested capital, I want to pay a lower multiple because there's more risk to the company. Debt works the exact same way. So let's go to our stock analyzer tool. And what we're going to do here is we use this tool to determine what to pay for the company. Now, keep in mind, it doesn't factor in the balance sheet, but every investment is the present value of all future cash flow, and our future is dependent on our assumptions. That's what you use this model for. You use revenue growth assumptions to drive everything below. That's very key when looking at a company. Now, let's put in some assumptions here. So in the last 10 years, revenue growth 7.5%, and it's grown a little bit over the years. But my goal is to be conservative and find companies that are selling for below my conservative estimates. So I'm going to go with 2, 4, and 6% revenue growth. Profit margin, pretty stable. I'm going to do 12, 13, and 14%. Free cash flow margin, I'm going to do the exact same thing because it's also pretty close. PE. Now, guys, low return on invested capital, high debt. I'm going to keep this PE a little bit lower. I'm going to go with 10, 13, and 16. And the reason I'm going to go with a little bit higher is Comcast is involved with sports, and sports are going to be a great way to advertise. So I'm hoping that there's still some synergies with them in the sports community. So I'm still going to put high side 16 PE and price of free cash flow. And finally, guys, I'm going to do a 15% return. I usually do a 12.5% desired return, but in this situation with the high debt and the low ROIC, even though I took it out on PE and price of free cash flow, I just don't like that debt level of 11 times free cash flow. I'm hit the analyze button. Now, guys, before I show you the numbers, I want you to remember, if it's all green, it doesn't mean go out and buy. If it's all red, it doesn't mean avoid it. It all depends on how green it is. You have to go reevaluate these numbers, make sure you're accurate. And if it's all red, if it's close to the number, though, do more research. Scroll down below. Okay, we're actually not far off. The high has a value of 50, the low is 27, the middle is 37. So we're pretty close to the middle number. I like these numbers. So to me, what I'm going to do next, if I were you, I'm going to add this to my watch list at 36. And remember, guys, it's going to change every time I do this thing, this analysis, and I'm going to go verify these assumptions. Are these assumptions reasonable? I'm going to do more research on the company. I'm going to look at their debt levels. Can they manage? What would have to happen? What happens to the company if the interest rate on their debt skyrockets? Company number 2, Kohls. So guys, Kohls is just like everybody else in retail. They're going to go through a lot of changes in retail. What I do like about Kohls is Amazon's doing a great job of making Kohls their go-to source for returns, and Kohls loves it because it brings people into the store. So let's go look at Kohls using our software. KSS is a ticker symbol. The stock is currently at 30, had a 52-week high of 64 and a low of 26, and that low was just a couple days ago. July 26th. All right, so a few other things on the company. $19 billion in revenue, $3.8 billion market cap, very low PE, 4 and 6. Dividend yield of 4.4%, pays out $171 million, but they can easily afford that. Now, I will say this. Their 5-year average free cash flow is $1.1 billion, and last year they did $766. So immediate red flag. Why is free cash flow lower last year? So the first thing I'm going to do is go right to the cash flow statement. What is this telling me? Now, guys, we added the free cash flow line here to make it easy for you. So 1.44, 1.17, 795, 1.33, 766. And if you look at their previous 5 years, it was pretty inconsistent as well. So in a company like Kohls, I want to make sure I'm understanding their free cash flow. And I also want to go to their revenue side. So look at this, revenue over the last 10 years. That ain't good. That ain't good. It's down. So another thing I want to do is look at Kohls, how many stores they have, what are the same store sales when it comes to retail, how are the stores that have been open 12 or 18 months doing, and then go find out what are they doing as a company to make them more relevant as the country becomes more and more and the world becomes more and more reliant on online sales. Let's go to the stock analyzer tool first and see if it's even in the ballpark for more research. So, no revenue growth for the last 10 years. I'm going to do -2, 0, and 2%. Profit margin, I'm going to go 3.25, 3.5, and 3.75. Notice I'm ignoring last year's profit margin. As you can tell from the previous 10 years, that's a fluke year. So I'm going to ignore that completely. Free cash flow margin. And right here, I'm ignoring this free cash flow. 4% last year. Previous years were a lot higher. So I'm going to go 5, 5.375. I'm going to go 5, 5.4, and 5.8. PE. Now, guys, I do think a 4 and 5 PE is very, very, very low, even for a company that has potential to lose revenue. I'm going to go with 6, 9, and 12. 6, 9. Actually, you know what? 6, 8, and 10. Because even a 2% growth rate is pretty low. And finally, guys, I'm going to do 15% annual return again. Because again, it's retail. It's got problems. It's got issues. I'm trying to be conservative. Am I being too conservative? Maybe. That's for you to decide. But this is the way I do it. Because my goal is to research 10,000. My goal is to do as many stocks as I can and find 20 to 40 that work. There are 10,000 stocks out there. Let me find the 20 or 40 that work for me. Hit the analyze button. Wow. Look at this, guys. Almost all green. So just to be safe, I'm going to add this to my watch list at $28. Notify me there. So guys, to me, this screams, go do your research. Go do your research and see how these assumptions play out. Let's go to the 8-pillar tab real quick. I forgot to do that. One thing I want you guys to do is this long-term liabilities, that probably has a lot of leases in there for their space. So that doesn't worry me as much. Verify that first. But yeah, revenue growth is bad. Cash flow is bad. But they're buying back a ton of shares of a cheap company. I like seeing that. Good ROIC, buying back shares at a 4 and 6 PE, and price of free cash flow. I like that. Stock number 3, our good friend Roku. Cathie Wood loves her Roku. So let's go look at Roku. This company has been hammered. It's at $77 a share. It was at $421 just a year ago. And that was pretty much, $475 is the high. Just over a year ago. That's epic. That's a massive fall. And I guarantee you, I can 100% guarantee you that if I had said Roku wasn't worth anywhere close to $40 a share, I would have been bombarded in the comments. You're an idiot. You're stupid. You don't get it. So be it. So let's look at the 8 pillars here. Oh boy, a lot of X's here. 700 PE, 195 price of free cash flow, increasing their shares outstanding by 58%, a lot of debt. Now they are growing their net income, revenue, and profit, and cash flow, I mean. Oh boy, this is bad. This current PE 75, no dividend yield. Oh boy. Guys, honestly, if I were looking at this company just right now, I'm passing on it. But who knows? And the reason being is, even if the numbers make sense, there's too much unknown out there. Roku's got a lot of competition, but let's go look at their revenue growth and put it in the stock analyzer tool. So I'm going to do 10, 15, and 20% revenue growth, significantly lower than their 5-year numbers. Profit margin, I'm going to do 4, 7, and 10. So I have to think that as they grow their revenue, the profit's going to go up. I'm going to do the same thing for free cash flow. PE, 14, 16, 18. Yes, I know it's much lower than they are today. And I'm going to do 15% revenue, desired return. And I think it should be higher than that. Analyze button. Okay, guys. So we're sitting here at a low of 14, a high of 87, a middle of 40. To me, these are too wide of range. I would avoid the stock. Guys, I appreciate you watching this. If you want to learn more about our 8-pillar process, please watch the next video above about our 8-pillar process. Don't forget to subscribe to our channel.